Hello and welcome to this video where we are going to take a look at job order costing. Our learning objectives for this video are we're going to learn about job order costing versus process costing. We're going to learn how to record materials, labor, and then actual and allocated overhead in job order costing systems. And then we're going to look at recording the completion of jobs, the sales of finished goods, adjusting for over or under allocated overhead, and finally calculating cost of goods manufactured and cost of goods sold, which we have actually seen before. So those are reviews. Also in the chapter are job costs for a service company, but in order to keep this video at a reasonable length, we are going to skip that for today. Once you know how to work for a manufacturer, you'll be able to apply the same thing for service companies. All right, so there are two ways to account for product costs. Remember that companies that manufacture have materials, labor, and overhead. And there are two main ways to account for these. One is the job order cost system, and this is a system that is used when there are jobs or batches that are unique. A good example would be a printer. So think about the printer that printed your textbook, if you have a paper textbook, or even a printer who prints things like wedding invitations. Each job is different from every other job, and they want to keep track of how much the costs were on that particular job. An alternative to that is the process cost system. The process cost system is used when there are different processes being applied to the same product, and most of them are the same. So the products are all the same, and the costs are accumulated over time as opposed to by job or batch. An example of that would be a paint manufacturer, say where they mix together various things to make the paint, and then they blend the color, and then finally they package it. So those would be the different processes. So we're going to focus on job order costing system. Here is a diagram that shows what the job order costing system cost flow looks like. Remember that we have materials, we have labor, we have overhead, and all three of those, materials used, direct labor, and then the allocated overhead, which we're going to talk about, all go into work in process. Remember our work in process inventory. And that's where they are until the jobs are finished. When they're finished, they go to finished goods, and then they are eventually sold and go to cost of goods sold. Remember the idea of product cost. Product cost is a cost that is attached to inventory and is an asset until it's sold, right? So we have direct materials inventory, work in process inventory, finished goods inventory, and finally, when it gets sold, it goes into cost of goods sold, which is an expense. The cost of each job is accounted for separately because, of course, you're going to bill each customer and you want to know how much that job cost you. So let's take a look at recording materials and labor costs. There are a few different materials transactions. One, first of all, you need to buy your materials, right? So they're going to purchase raw materials. Then they are going to requisition those materials and put them into production. And then finally, the cost of the materials that are used, of course, are kept separately for each job. So if you think of a printer, they're going to buy paper and cardboard and other things like that, and glue, and then they're going to put those into production using a requisition. So they need a certain amount of paper, which would be direct materials, and then a certain amount of glue, which remember would be an indirect material. So when they buy materials, remember raw materials inventory is an asset account. Recall that assets have a debit balance. So when you increase them, you debit them. So when you buy raw materials inventory, you debit it, and you credit either cash if you paid cash or accounts payable if you're going to pay for it later. Then when you put the materials into production, you're taking them out of your raw materials inventory. So remember, to decrease an asset like cash or like raw materials inventory, you credit it. So we're crediting raw materials inventory to bring it down, and we're putting those costs into work in process inventory, which is our direct materials, and manufacturing overhead, which is our indirect materials. We're going to take a look at this manufacturing overhead account in detail in a minute. But remember that things like glue, that are not traced directly to a particular item are considered indirect materials, and those go into overhead. Now labor, of course, is not purchased, and we don't have labor inventory. So labor comes about when the factory workers work at their jobs. And there is both indirect and direct labor incurred. Remember, direct has to do with the people that are working directly on the product, with the product. And then the indirect laborers are people who work in the factory but not on the job. So maybe they're maintenance people or supervisors. Again, the cost is kept separately for each job. The journal entry looks very much like materials. We're going to debit work in process inventory for our direct labor. We're going to debit manufacturing overhead for our indirect labor, and then we're going to credit wages payable or cash for the total amount that we are paying. So there is no expense here for our labor. Remember that when you're looking at product costs, they're all going into inventory until the goods are sold. Now let's take a look at the manufacturing overhead account, because we haven't seen that before. Manufacturing overhead is an account that is used throughout the period, and then at the end of the period we're going to close it out. So you have on your debit side, you have actual overhead costs incurred. So let's say you pay the rent on the factory. You're not debiting rent expense, you're debiting manufacturing overhead and crediting cash. Okay? And then we're going to see how we allocate the overhead. And that allocated overhead is a credit. And then at the end of the period, we're going to fix the difference between the actual and the allocated. Stay tuned for that. All right, so this is what our manufacturing overhead might be hit by. It's going to be debited by indirect materials, indirect labor. We saw that already. Other kinds of overhead might be, of course, there are others, factory rent, for example, depreciation on your factory equipment, insurance, utilities. So any of those costs will get debited to manufacturing overhead, and whatever is credited, it would be cash or accounts payable, or we'll see some other examples next. So let's say you're recording depreciation on your machinery. You debit manufacturing overhead, and you credit accumulated depreciation just like you would if you debited depreciation expense instead. So our credits here are the same, but our debit, instead of to an expense, is to overhead. Same thing with insurance. So let's say some insurance expired, we're debiting overhead and we are crediting prepaid insurance. Now, here's the issue. How do we know the cost of a product? We have to tell the customer, okay, it's going to cost you X number of dollars for this printing job. Well, in order to give them a quote for how much it's going to cost them, we need to know how much it's going to cost us first, right? Because of course we need a markup. We need some profit on the job. Now, how are we going to know the cost of that product if we don't know how much overhead goes in? So the answer to that is that we use an allocation. And the way we allocate overhead is called a predetermined overhead rate. This is calculated at the beginning of the period, and the way you calculate a predetermined overhead rate, this is something you have to memorize, is that you divide your total estimated overhead costs by your total estimated allocation base. So we're allocating our overhead based on some kind of a base, and your base could be commonly direct labor hours, direct labor dollars, or machine hours, depending on the nature of the company. And there are other possibilities. Those are fairly common ones. Now, how do you allocate the overhead to a job? So now we have our predetermined overhead rate, and it's going to give us a rate per labor hour or labor dollar or machine hour. And once we have that rate, we take the predetermined overhead rate and we multiply it by the actual quantity of the allocation base used on a particular job. So let's see how that works. Let's say we have this information here. We have estimated overhead for the year of $150,000. Our estimated direct labor hours are 10,000, and that's going to be our allocation base. So we're assuming that we're using direct labor hours. Job number 752 used 200 direct labor hours. So the first thing we're going to do is calculate our predetermined overhead rate. And we do that by taking our estimated overhead, 150,000, divided by our estimated direct labor hours of 10,000. and we get $15 per direct labor hour. So if you divide overhead by hours, you get overhead per hour, right? So that's our predetermined overhead rate. Next, we're going to allocate the predetermined overhead. We're going to allocate the overhead to job number 752. So it's $15 per direct labor hour, and we said that this job used 200 hours. So we're going to take the $15, multiply it by the 200 hours used, and that's going to give us $3,000 allocated to job 752. Finally, we're going to journalize this, and we're going to record the actual allocation of the overhead. And remember, we said we debit the allocated overhead is what goes into work in process inventory. So we're going to debit work in process inventory for $3,000, and we're going to credit manufacturing overhead for $3,000. Remember, the allocated overhead gets credited. Okay, so that's how we journalize the overhead for a particular job. All right, let's take a look now at what happens when the jobs are complete and then they get sold. So the first thing that happens is, of course, the job is moved from work in process inventory into finished goods inventory when it's done. So remember, these are inventories. Our finished goods inventory is going up, so we are debiting it because it's an asset, right? Our work in process inventory is going down, so we're crediting that. So debit finished goods, credit work in process for the jobs that have been complete. And then once the jobs are sold, we're going to make two different journal entries. So we're going to debit accounts receivable or cash and credit sales revenue. That's the sale. That's recording the sale. And that entry is at selling price. So we're saying here that we made a sale and the sale was for $150,000. Then the second entry is to take the cost and record the cost of goods sold and then remove the goods from finished goods inventory. So the inventory is going down, so we're crediting inventory and we're debiting cost of goods sold for the cost of the merchandise. Okay, now what is the gross profit on this sale? Hopefully you remember that gross profit is equal to net sales minus cost of goods sold. So in this case, we're just going to use our sales revenue. So our sales revenue was $150,000. Our cost of goods sold is $65,000. So the gross profit on this sale was $85,000. Now let's take a look at adjusting overhead. So at the end of the year, this is just a reminder of what goes into our overhead. At the end of the year, we have a balance here of actual overhead. So here's one example, here's another. We have two separate examples. We're going to have a balance in actual on the debit side, and we're going to have a balance on the credit side. So let's say at the end of the year, we had debits of $150 and credits of $139. So our balance is a debit balance of $11,000. That means that our actual overhead was greater than what we allocated, which means we didn't allocate enough overhead that year. It was underallocated, which also means, excuse me, our cost of goods sold is too low. The opposite happened over here on this side. Our actual overhead is $139, and our allocated overhead was $150. So we actually allocated more than what we needed to allocate, and so our cost of goods sold is too high. All right, so in this case, we are over allocated. Our cost of goods sold is too high. So let's take a look now at how we deal with this cost of goods sold too high and cost of goods sold too low. So what we're going to do is, basically our goal here is we want to close this account. So if you remember from financial accounting, when you close an account, you make it have a zero balance. So for example, here, if we want this to have a zero balance, we have to credit it, and here we have to debit it to make it have a zero balance. So if it's under allocated, we credit the overhead to close it, and we debit cost of goods sold. Remember, we didn't put enough in, we under allocated, we didn't put enough into our cost of goods sold, so now we have to increase our cost of goods sold. Here is the opposite. Our manufacturing overhead had a credit balance, so we're going to debit it to close it, and we credit cost of goods sold because we put too much into our cost of goods sold, and now we're going to reduce it. Remember, cost of goods sold is an expense and it has a debit balance. All right, finally, let's just do a quick review. There's going to be totally separate totally separate videos to walk you through these, but just as a way of reminder, where do all of these things end up going? They go into our cost of goods manufactured, and then our cost of goods manufactured go to our income statement, and our income statement might look like this. So these are just made up numbers. They don't really have anything. They're not related to what we just did except for our overhead. So remember that our cost of goods sold looks like beginning inventory plus cost of goods manufactured gives us cost of goods available for sale minus ending finished goods inventory would give us cost of goods sold. But now we have a little adjustment to our cost of goods sold. So we have cost of goods sold before adjustment. Then we have the adjustment for underallocated or overallocated. In this case, it was underallocated, meaning we didn't put enough money into cost of goods sold, so we're going to add it in. And then that gives us our cost of goods sold, which of course is subtracted from our net sales revenue to give us gross profit. Okay, so that's all I have. I think that will give you some good background, and you will be ready now to work on your chapter materials. See you in the next video. Happy studying.